to 28. May 26 to 28. And I am going to give your last exercise will be given on May 10. Meaning sa Monday nga May 3, wala kita quiz. So I'll give the last exercise on May 10. On May 17, you have long exam 4. May 17, long exam 4. And the final exam will be on May 26 to 28. And in the book of Hansen and Moen, we are still to take up chapters 2, 3, 5, 6, 7, and 8. So that will be beginning today up to May 25. Up to May 25. So meaning we are going to take up all the remaining problems in the book of Hansen and Moen before we end up with our class for accounting 1 to 06. Okay? So now I am going to lecture on chapter 2. Ma-lecture ako on chapter 2 with the PowerPoint presentation. And you will notice that some of these were already taken up in the book of Van der Beek, including absorption and variable costing. Meaning, we will simply be repeating those topics as we have already taken them up in the previous book. Okay? So, we have now the topics here. Pricing and profitability analysis. Pricing and profitability analysis. So in other words, we will be discussing with these learning objectives. Discuss basic pricing concepts. Calculate the markup on cost and the target cost. Discuss the impact of the legal system and ethics on pricing. Explain why firms measure profit and calculate measures of profit using absorption and variable costing. Compute the sales price, sales volume, contribution margin volume, sales mix, market share, and market size variances. Discuss the variations in price, cost, and profit over the product life cycle. Describe some of the limitations of profit measurement. Okay, so you will notice that some of these topics were really taken up in the book of Van der Beek, including absorption and variable costing. Now we have demand and supply. With all else equal, customers will buy more at lower prices and less at higher prices. Now, by the way, I know that you have already taken up demand and supply in your economic subjects. So, in other words, these are simply review of what you have already taken up. Producers are able to supply more at higher prices and less at lower prices. Market clearing or equilibrium price located at the intersection of the supply and demand curves. Price at which supply equals demand. Price elasticity and market structure influence a company's ability to adjust price. So, in other words, we have your demand and supply to be considered, no, in the case of your economics subjects. Okay, so we have now your demand and supply. uh, we have factors other than price that influence demand. Consumer income, quality of goods offered, availability of substitutes, demand for complementary goods, whether or not the good is a necessity or a luxury. Okay, so we have now the economist approach to pricing. Okay, take note, I have already mentioned that you have taken up demand and supply under your economic subjects. So we have now the approach of the economist to pricing. Elasticity of demand. The price elasticity of demand measures the degree to which the unit sales of a product or service are affected by change in unit price. So we have now change in price versus change in unit sales. So in other words, we have to think of this very, very important relationship, that if you have a change in price, then you will have a change in unit sales. Now, price elasticity of demand. Demand for a product is elastic if a change in price has a substantial effect on the number of units sold. Now, that would be elastic. The demand for movie ticket, restaurant meal, and automobiles are relatively elastic because if their price will increase, unit sales will drop as customers seek lower prices elsewhere. Price elasticity of demand. Demand for a product is inelastic if a change in price has a little effect on the number of units sold. Example, the demand for prescription drugs, electricity, and toothpicks are relatively inelastic. Now we have the market structure and price with the four types of market structure. One is perfect competition, has many buyers and sellers, homogeneous products, easy entry and exit from the industry. Firms cannot charge a higher price than the market price because no one would buy their product, and they will not set their price lower because they can sell all they can produce at market price. Then we have monopoly. Barriers to entry are so high that there is only one firm in the market and the product is unique. So only one firm. The firm is the better, is the price setter. Legally enforced barriers to entry such as patent protection, specialized knowledge, or exceptionally cost production equipment. Next is monopolistic competition. Characteristics of both monopoly and perfect competition, but it is much closer to the competitive situation. There are many sellers and buyers, but the products are differentiated on some basis. Restaurants are good examples of monopolistic competitors. Each restaurant serves food but attempts to differentiate itself in some way: ethnic style of food, closeness to work or schools, availability of party room, gourmet or casual atmosphere, and so on. Then the last one is oligopoly. Is characterized by few sellers. Barriers to entry are high and usually are cost related. Examples for the cereal industry are Kellogg's, General Mills, and Quaker Oats, due to huge selling expenditures on advertising and space fees. Okay, now we are comparing these four market structures with the characteristics with regards to number of firms in the industry, barriers to entry, uniqueness of the product, and expenses related to structure type. So with perfect competition, there are many firms. Barriers are very low and the uniqueness of product is not unique, and the expenses related, no special expenses. Monopolistic competition, number of firms in the industry are many, barriers to entry are low, uniqueness of products, some unique features, and the expenses related to structure are advertising, coupons, cost of differentiation. Next, we have oligopoly. Firms in the industry are few, barriers to entry are high, fairly unique, and for the expenses, we have the cost of differentiation, advertising, rebates, and coupons. Then for monopoly, there's only one firm. The barriers to entry is very high. Uniqueness of product is very unique. Expenses related to structure type is we have legal and also lobbying expenditures. Cost and pricing policies. We have the cost-based pricing, target costing and pricing, penetration pricing, and price scheming and gouging. So these are now the cost and pricing policies. Okay, for the cost-based pricing, prices are established using cost plus markup. Markup is percentage applied to base cost. So includes desired profit and any cost not included in the base cost. So the markup on cost of goods sold. So in other words, the base is cost of goods sold. For the numerator, we divide here the sum of selling and administrative expenses plus operating income divided by cost of goods sold. So we have now the markup on direct materials, direct labor plus overhead plus selling and administrative expense plus operating income divided by direct materials. Next, we have calculating a markup on cost. Audio Pro Company, owned and operated by Chris McAnders, sells and installs audio equipment in homes and vehicles. Direct materials and direct labor costs are easy to trace to the jobs. Assemblers receive on average $12 per hour. Chris wants to find a markup on cost of goods sold that will allow her to earn about the same amount of profit on each job as was earned last year. Calculating a markup on cost. AudioPro's income statement for last year. What is the markup on cost of goods sold that will maintain the same profit as last year? So you have the revenues and the cost of goods sold is computed by adding direct materials, direct labor, and overhead. So the cost of goods sold deducted from revenues, leaving the gross profit. And we deduct selling and administrative expenses. The difference is operating income. Now, the markup percentage must include all costs that are not part of cost of goods sold plus desired profit. So we have the markup on cost of goods sold, selling and admin expenses plus operating income divided by cost of goods sold. So we have 25,000 plus 80,350 divided by cost of goods sold. So the markup of 43% of cost of goods sold. That's now your markup. So the take note that the denominator is cost of goods sold and the numerator is selling and admin expenses plus operating income. So we have now the revenue and deduct cost of goods sold, the gross profit, which actually is the sum of selling and admin expenses and operating income. The gross profit is 43%. 43% of your cost of goods sold. So we have the operating income of 80,350. Okay, 80,350. Next, we have the markup percentage. Here we have now direct materials per unit. Okay, we are now computing. Second method is using markup on direct materials. Now computing for the price of the new product, that's 140 multiplied by 1.43. So the price of the new product is 200.20. That's the price of the new product. Okay, now the price of the new product is equal to direct materials per unit 80.60, direct labor 36, overhead per unit is 23.40, so that gives the total cost of goods sold per unit of 140. So the price of the new product is 200.20. Now, if the markup is based on direct materials, so our numerator is direct labor plus overhead plus selling and admin expenses plus operating income. We divide it by direct materials. So we have now your direct materials of 122,500. So we add direct labor, overhead, selling and admin expenses, and the operating income. We divide it by direct materials. So we have now 1.86 or 186% of direct materials cost. That's the sum of direct labor, factory overhead, selling and admin expenses, and net income. So we have the rate of 1.86 or 186%. So the bid price now is 80.60. That's your original direct material cost. And then we add 1.86. Then that will give us the bid price of 230.52. So we add 1.86 multiplied by 80.60. So the bid price of 230.52 still will give us the operating income of 80,350. So with our revenues in the direct materials given, so that will give us the markup of 227,850. That includes the operating income, direct labor, and factory overhead plus selling and admin expenses. Okay, next we have your revenues is 286%. That's the sum of 100% and 186. So we deduct direct materials, which is our base. So the markup is equal to 227,850. That includes the items in the numerator. Okay, so that gives us 227,850 divided by direct materials, giving 186%. Next, we go to target costing and pricing. Sets the cost of a product or service based on the price or the target price that customers are willing to pay. Company's marketing department determine characteristics and price for a product that are most acceptable to consumers. Company's engineers work to design and develop the product that is priced to cover the cost and profit. Now, calculating target costing and pricing. AudioPro finds that other aftermarket audio installers price remote car door opening at $155, while their version is priced at $200.20. Cost details, direct materials, direct labor. They could offer one device instead of two, which would save $15. If workers are trained and efficiency improves, they can save $16. So we have now the prime cost equals direct material cost plus 15 minus 15 plus 36, your direct labor cost, minus 16, the savings. So we have 8560. The sum of direct materials and your direct labor. Now we have direct materials per unit, direct labor, and overhead. So the cost of goods sold per unit is $140. Calculating target costing and pricing, overhead rate can be brought down from 65 of direct labor cost to 50% or 10. Cost of one job would amount to 105.60. If the standard markup of 43% is applied, the price would be 151, which is well within the other firm's price of $155. Other pricing policies, penetration pricing, pricing of new product at low initial price to build market share quickly. Pricing is not meant to destroy competition. Price skimming, higher price is charged when a product or service is first introduced. Price gouging occurs when firms with market power price products too high. Now, predatory pricing, practice of setting prices below cost for the purpose of injuring competitors and eliminating competition. Dumping, predatory pricing on the international market. Price discrimination, charging different prices to different customers for essentially the same product. Robinson-Patman Act 1936 was passed to outlaw price discrimination, allows price discrimination under certain circumstances if competitive situation demands it. Cost can justify the lower price. Measuring profit. Profit measure the difference between what a firm puts into making and selling a product or service and what it receives. Reasons for measuring profit: to determine the viability of the firm, to measure managerial performance, to determine whether or not a firm adheres to government regulations, and to signal the market about the opportunities for others to earn a profit. Then we go to absorption versus variable cost. Measuring profit. As I've already mentioned, we have taken this up in chapter 10 of Vanderbeck. So meaning this merely a repetition or a review of these topics. So the company, a recycler of used toner cartridges for laser printers, began operations in August. Manufactured 1,000 cartridges with the following unit cost: direct materials 5, direct labor 15, variable overhead 3, fixed overhead 20, which is computed by dividing the fixed overhead per month by 1,000 units produced. So it's 20 per unit. Variable marketing cost 1.25. Okay, so the total fixed factory overhead is $20,000 per month. During August, 1,000 cartridges were sold at 60. Fixed marketing and administrative expenses were 12,000. Now, let's compute for the net operating income by using absorption costing. We have discussed that in absorption costing or full costing, in determining product cost, we have to include direct materials, direct labor, and factory overhead, fixed and variable. So that's direct, variable, no, absorption or full costing. Okay, so we have now sales of 1,000 units, cost of goods sold at 43. That's the sum of direct materials, direct labor. Then we have your here. So direct materials 5, direct labor 15, so it's 20, variable overhead 3, and fixed overhead 20. So the manufacturing cost per unit is 43. Okay, so we have now 43 per unit. That's your manufacturing cost per unit. So multiplied by 1,000 units, you get 43,000, the gross profit. We call it gross profit for absorption or full costing. So we deduct variable marketing expense and fixed marketing and administrative expense. So we have now the operating income of 3,750. Take note that production is equal to sales. And we have now the percent of sales by dividing each item by sales. So we divide cost of goods sold 43 over 60. That gives us 71.67, and the same with the rest of the items. So the operating income is $3,750 at 6.25%. That's now your percentage of sales. Then for variable costing, we have to remember that in variable costing, your product cost will include only direct materials, direct labor, and your variable factory overhead. Fixed factory overhead will be treated as period cost together with your marketing and administrative expenses. So now we have the variable cost per unit. For cost of goods sold, 23. That's the sum of direct materials, direct labor, and variable factory overhead. And we have now the variable marketing expense. So the contribution margin, again, we define contribution margin as difference between sales and the variable cost. So contribution margin with the corresponding percent of sales. Again, that's computed by dividing each amount by sales. So we have now contribution margin minus the fixed factory overhead of 20,000 and marketing and administrative expense of 12,000, leaving us the difference of operating income. Now, be reminded of the rules that we have. Rule number 1, if production is equal to sales, net